Okay, well, I think we'll get started. So for those of you that don't know me, my name's Cathy Lorenz. I'm a CPA. I have a master's in tax, and I just officially today on October 15th finished my 40-year career in public accounting. Today's my official retirement day. And I think I should remember this stuff for a little while, so we'll see how the brain works. But today I'm going to discuss a few ways that we can structure our charitable donations to save taxes. But before we start, I wanted to share a few quotes from some famous people that will be relevant to today's discussion. Paul told us in Romans, contribute to the needs of God's people. Paul, who we've been studying and reading for several weeks now in this church, reminds us of the duty to give. Jesus tells us we should pay our taxes. In Matthew, he says, render therefore to Caesar the things that are Caesar's, and to God the things that are God's. And the relatively famous Justice Learned Hand, he was a U.S. Supreme Court justice, said a long time ago, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose the pattern that will best pay the treasury. There is not even a patriotic duty to increase one's taxes. So today we're going to spend a couple minutes talking about a few things specific to the tax treatment of charitable contributions that may help you do just this, which is not overpay your taxes. These are some of the areas that we're going to discuss today, some of the techniques, I guess I'll call them. One of them we refer to as bunching. That's not an official term, but it's when we talk about it. That's what we call it in public accounting. Donor advised funds, which are very popular these days, and there's lots of them out there. Donations of appreciated stock, which has been around for a long time, but a lot of people don't realize the power that you can have by doing that. Private foundations, which are a type of similar to a donor advised fund, but different in several ways. And then two really more super high-end planning techniques, which are called charitable lead trust and charitable remainder trust. And I'll just spend a couple of minutes on each of those, but it's something to understand and know about. And if you have any questions, feel free to raise your hand and ask. I'll try to answer them as we go along. I'm going to try to keep this not too technical because it can get really technical. So I will try to keep it at a high level. So the first one, and this has been really more popular since 2017 when the tax laws changed. Two things happened then. The amount of taxes people were allowed to deduct was limited to $10,000. It used to be whatever your taxes were. So you would add up your property taxes and your income taxes and your license plates, and you could deduct all of that. Well, that's now limited to $10,000. The second thing that happened in 2017 is the standard deduction went way up. So the standard deduction is the amount you get to reduce your income by if you don't itemize. And that was raised quite a bit. So a lot of people don't itemize anymore for those two reasons. And you probably remember reading or hearing when this was happening that charities were saying this is going to hurt the charitable community. And actually during COVID, there was a special rule where you could get a charitable deduction. It was very small, but you could get a charitable deduction even if you didn't itemize. That's gone away now, but that was something that they did during COVID to encourage people to continue to donate because there was so much need. So the idea around bunching is to group several years' donations into 1 year so that you can use the standard deduction in the other years. And over time, you will pay less taxes without giving any more. And I have an example and I'll try to go through it, hopefully so that you can understand it. So in this example, in year one, in the first column, this person has $9,000 in property taxes, $6,000 in income taxes, $5,000 in mortgage interest, and $10,000 in charitable donations. And they have the same in year two. Nothing changed. Their taxes didn't go up and their mortgage didn't go down. I don't know how that happened, but that's what happened. So without bunching, what their income tax return would look like in year one is they would deduct $10,000 in taxes, $5,000 in mortgage interest, and $10,000 in charitable donations, which would equal $25,000. But the standard deduction, and this is a married couple in this example, is $27,700. So they would take the standard deduction and they would do the same thing in year two. So the total amount of deductions they would get on their returns over the 2 years in this example is $55,400. If, however, in the columns on the right, they were to give all of their charitable donations in year one, their deductions would be $35,000, which is more than the standard deduction, so they would get some benefit. And in year two, their deductions would be significantly less than the standard deduction. They would take the standard deduction. So in this example, in the second year, they would, over the 2 year period, they would get $62,700 as opposed to the $55,400. At the 25% federal tax bracket, that saves somebody $18,025 in this example. And they've spent exactly the same amount of money. The way that we often would recommend our clients to do it would be to, for example, coming into 2024, give your pledge to the church all during the year. And then in December of 2024, upfront, if you can afford it, your 2025 donation. And don't give anything in 2025. So you've bunched them both into 1 year. That's how bunching works. And we have a lot of clients that do it. Mike and I do it ourselves. Yeah, Greg.
Is there a fixed amount above which you're better off doing this than taking the standard deduction? You have to hit a certain threshold.
Yeah, you have to get, if you're not going to get over the standard deduction, even with the bunching, it might not make sense. But you could bunch, in this example, we're just bunching 2 years. You could bunch 3, you could bunch 4, you know, you could, you'd have to sort of do the math for yourself and see. But if you, this is available online. If you go back and look at this example, you could mock up your own and see, does this make sense for us? And will it be worth it? So, but a lot of people use this technique. It's fairly simple, especially if you know you're going to donate anyway. So this is one technique.
Cathy, is there a limit of how many years forward you can pull back in order to bunch?
Nope.
Okay, that's the next thing the government will think of.
Well, no, they can't control that because we're all cash basis taxpayers. And if you make the donation in the year, you get the deduction in the year.
Okay.
So there's really no way for them to hurt you with that. There is a limit. It's 60% of your adjusted gross income. So I guess in that regard, there is a limit. If you pull back so many years that you're over the 60% of your adjusted gross income, then you're limited and you carry it forward.
Okay.
So I guess, yeah, that's how they get you, but not too many people hit that. That's a pretty big number. All right. The next example we're going to talk about is something called a donor advised fund. And really what this is a more formal bunching tool. A donor advised fund allows the taxpayer to bunch donations in a different way that provides regular annual cash flow to their charities of choice. It also gives them flexibility should situations change. So let me talk about what they are. So donor advised funds are set up by wirehouses or community foundations. Fidelity has one, Vanguard has one, Schwab has one. I know there are community foundations that function like donor advised funds in Michigan. I can't, off the top of my head, don't know the names of them. Do you know one, Greg?
No, I'm formulating the question.
Okay, all right. So what happens is, in that example, for example, you might put $20,000 into your donor advised fund in year one, going back to the example that we had, you'd get that deduction. And then you would instruct the advisor at your donor advised fund, send $7,000 to the Grosse Pointe United Methodist Church this year and $2,000 to the Salvation Army this year. And then next year you would instruct them, send $7,500 to Grosse Pointe United Methodist Church and $1,000 to Gleaners or whatever you want. You instruct them and they remit the money at your request to the charity of your choice. The reason that people like this mechanism is it provides for flexibility of donees later on. So, you know, if you pull all your donations together and gave all your money to the Michigan State Athletic Foundation, you might not be feeling so good about that now. If you had put it in a donor advised fund, you could change your mind later and say, you know, I gave to Michigan State Athletic Fund last year, but this year I want to give to some other fund. Yeah, Greg.
So if you have a substantial amount in a Fidelity account, for example, do you have to sell part of that in order to allocate it to the donor advised?
No, and we'll talk about that in a minute. You do not. You do not. You can move it. And there's a tax advantage to doing, there's a tax advantage way to do that. The other thing though that I want to make sure that people understand about donor advised funds is you can only distribute what I'm going to call cash donations. So you have a event like the Methodist Children's Foundation is having a dinner and you want to buy a table. You can't do that with donor advised fund money because a portion of that donation is not tax deductible because you get a dinner. So that's one of the downsides of it is that you can't use it to, you know, buy wreaths from the Boy Scouts or things like that. You know, you can't use it to buy downstairs. But it's very good for making cash donations directly to charities. The other thing that people like about it is the funds are continuing to be invested and earning. And so that's a positive thing while they're in your donor advised fund. So they're and lots of people use this. Yes.
But it's up to the manager of Fidelity, Vanguard, Schwab to decide how it's invested.
Right, exactly. You work with them, you would have a, you know, investment policy statement for your donor advised fund and you'd be continuing to grow and earn. Okay. The next thing we're going to talk about is donation of appreciated stock. So this method takes advantage of the tax rule that the donor gets a deduction for the full value of the stock, but does not have to report the gain on their income tax return because the charity is going to sell the stock and the charity generally is tax-free, or in some cases, if they're a private foundation, they pay a very small 1.39%. It's really, really small. So this is a super powerful tool if you have built-in gain stocks that you've held for a long time that have a lot of appreciation in them. They're great tools for funding donor advised funds. You move the money from your one investment account into your donor advised investment account. You don't have to report the gain. The donor advised fund sells the stock. They pay the tax at 1.39% because they're essentially private foundations. Oh, actually, I think some of them are public charities, which don't pay any tax. And you get the full donation deduction. The one thing about giving appreciated stock is the amount of the deduction that's allowed annually is limited to 30%. I told you it was 60. It's 60 for cash. It's 30 for appreciated stock, but that's still probably more than most people are doing anyway. And if you exceed the limit, you just carry it over. It's not lost. Yeah.
This applies to mutual funds as well.
Oh, yes, yeah. You could, as long as it's a capital gain, not deferred interest, like a bond. You know, but you can do it with stocks, mutual funds, those types of things. So here's an example of what happens when you donate appreciated stock. So in this example, the donor owns ABC stock they bought for $50 that's trading at $175 today. They want to give $10,000 to Grosse Pointe United Methodist Church. So that's about 1,000 shares, or excuse me, they have 1,000 shares. Their tax basis is $50,000. The fair market value is $175,000. If they sold all that, the built-in gain would be $125,000. If they instead donate 57 shares of the stock as opposed to selling 57 shares of the stock to get to that $10,000, they get, in my example, this $9,975 deduction, but the $7,125 built-in gain on the stock is not taxed to them. They don't have to pay the tax. So that saves $2,138 in this example. So what happens when you do this with donated stock is the charity gets the same amount of money that you want to give them, but the donor is out of pocket significantly less. They're out of pocket $9,000 in value of stock, but they've saved $2,000 in taxes. So this is a great way to use appreciated stock to fund, and most all charities take appreciated stock. Grosse Pointe United Methodist Church does, and I'll show you how we do that here. Absolutely, donor advised funds do. Probably every charity that you support takes appreciated stock. So certainly think about this if you've got stock in your portfolio, and you know, you can, if you like the stock and you want to continue to hold it, you could always just rebuy it, I suppose, but without triggering the gain. You have a question, Kathy?
No,
Okay.
no, I'm listening avidly.
Okay.
All of this is new to me.
Mike?
The large investment I had with Vanguard was rolled from my 401k when I worked for Sears Holdings. Okay, so it went direct, then I took all that stock money and put it into Vanguard, so it's still considered a 401.
It's an IRA.
account. Yeah, it's an IRA account with Vanguard. So does that complicate the situation?
You can't use that for this technique, but there's another technique we're going to talk about that you can use IRA money for.
Okay.
Yeah, so this is money that's in an account that's after tax.
Okay, yeah, also, you can't use this for a 401k.
Correct. Yeah. Yes,
Does the church stock, sell the stock or hold the stock?
the church sells the stock always.
Okay.
Yeah, right away. So we don't want to be holding stock. We want to convert it to cash. Yes.
Now, back to the donor advised fund. That same prohibition stands for IRAs and 401ks.
You can use an IRA to fund a donor advised fund, but this next technique that I'm going to talk about doesn't work. Or one of the techniques I'm going to talk about doesn't work with that, but you can do it. Okay. These are the instructions. They're a little small. We have some in print. If you donate stock to Grosse Pointe United Methodist Church or any other charity, and for that matter, it's really important that you notify the organization of your gift, because the organization is only going to see a transfer of shares coming in and a brokerage account and an account number. Your name doesn't show up anywhere. So they aren't going to realize that this is from Greg Gardner or Mike Bernhardt. So it's important that you contact, at our church, Rod Rask. He's the person who handles this with our account, and let him know I'm donating 57 shares of ABC stock to Grosse Pointe United Methodist Church. Keep an eye out for it, and he will. And then what happens, I think most charities, because they have their own investment policies, they don't necessarily want to hold a stock that you gave them. They sell the shares. They will tell you in a letter the high and the low for that day, which is the what you average those two together, and that's how much of a deduction that you get. And you'll get a letter for our church. You'll get a letter from David that'll give you that information that you can use for your taxes. So if you, yep.
I just want to vouch that I've done this for about the last 5 years and it works extremely well and it's pretty seamless. And if anyone's got, stock in the company they work for, or anything they've told for a long period of time, it's really a wonderful way to donate.
It is, the savings is significant. Because if you think about it, if you sold that, you'd pay federal and Michigan tax. That can be a lot of money. Okay, qualified charitable distribution. So this is what we were talking about with your IRAs. This is a super easy and very efficient tool for anybody that's over 70 and a half that wants to use their IRA funds to help charities support organizations that they like. So the rules are, you have to be 70 and a half. Both spouses can do it. So, if you're married, you can use an inherited IRA as long as you're over 70 and a half. So this is really in a situation where you're taking what's called your required minimum distribution, which if any of you have ever had an inherited IRA from somebody other than your spouse, they also have required minimum distribution. So my kids inherited an IRA from their grandma. They're not 70 and a half, but if they were old enough, they could use this technique to make donations. So what happens here is you essentially just tell your IRA custodian, I want to make a $5,000 donation to Grosse Pointe United Methodist Church. Please transfer the money directly from my IRA to them. And so they'll cut a check and send it to the church on your behalf. What happens is you don't have to report that as income. Now, you don't get a charitable deduction, but if you're not itemizing anyways, you don't need the charitable deduction and you don't have to pick up the income. Depending on your age, this also can save you state taxes. There's a whole series of different rules on who gets to exclude their IRA from tax for Michigan purposes, but some people cannot. So there's a federal savings and a state tax savings, super, super easy. You don't have to do your whole RMD. You can say, if your RMD is $25,000 and you want to donate $5,000 and you're going to do it anyway from other money, just do it from your IRA. It makes total sense. So this is a great, great, great technique. There's something called the Secure Act that came out recently that made changes to the age when people have to start taking their RMDs. Like I won't have to start taking my RMD, I think, till I'm 72. I can still make a qualified charitable distribution at 70 and a half, even if I don't have to take my RMD till I'm 72.
Sorry, what's an RMD?
Your required minimum distribution. Yeah, once you turn 70 and a half, you have to start taking your money out of your IRA. There's an anti-abuse rule. It's a little bit technical, but if you're still working and you're making donations to an IRA and you're taking distributions from an IRA, you can't do both. You can't do this with that. So
I think our advisor told me, I have some annuities to which that R&D requirement applies. And he told me you don't have to start taking the R&D until the year after you turn 72.
yeah, April 15th of the first distribution, you get a break, but then you'll have to take 2 in that year. But that's a different conversation than this one. But yes, that's correct. Yeah, yes, that's true. Okay, so these are getting a little more complicated as we go, obviously, but this is a great, great tool for anyone that's in a position where they're taking required minimum distributions. So here's an example on how that works. So someone has $75,000 in other sources of income, interest, dividends, Social Security, whatever, all that is. They have required minimum distribution or gross income from their IRA of $25,000, and they take the standard deduction. So their federal tax in this example would be $18,075. And then they give the $10,000 donation to the church, carrying that through from the earlier examples. The net cash to them after paying their taxes, making their donation would be $44,225. If instead they made a qualified charitable distribution of $10,000, not their whole IRA, but just 10,000 of it, their tax would go down, and in this example, they would save almost $3,000 in federal and state taxes. So again, this is a super easy, very easy way to save money. And, you know, as Craig said earlier, either use that money to make more donations or just put it in your pocket.
And Kathy, just this, because of what your editor says, this only applies if you're not itemizing.
Well, no, you can do it anyway, but if you're not itemizing, it's way more powerful, right? Because it doesn't affect your deduction.
But you can do it either way, whether you're not itemizing or you're itemizing.
Correct. The math will be a little bit different.
Okay.
Because if you're itemizing, you're getting a tax benefit from the deduction. I'm assuming you're not getting in this example, I'm assuming you're not getting a tax benefit from the deduction.
Okay.
So, I just wanted to be clear about what the rules are. The next couple methods, as I said in the beginning, that I'm gonna try to explain as clearly as I can, are really not income tax techniques. They're estate tax planning techniques that involve charitable donations as part of your estate plan. They're used by people that are wealthy mostly, and they can also be used to help people engage their family members in their sort of donative intent. We have some clients that set up some of these things while they're alive so that their kids can start understanding what they give and how they give and the charities that they like to support. So the first one is called private foundation. So what a private foundation is, it's essentially a private donor advised fund with no pooling of money. So when you put your money in a donor advised fund with Fidelity, you have your own account and you will see it there, but it's really for tax purposes pooled with all the other donors that are part of that. And that's how it functions well for the wirehouse. A donor advised or a private foundation is completely different than that. You set up a corporation or a trust. It's a legal entity that you have. You open and you petition the IRS for it to be a charity. And now you have the Ford Family Foundation. And that's a private foundation. It's probably a public charity now, but when it was first set up, it was a private foundation. They have very specific rules about how much they have to give. They can really kind of be invested in any way they want. They have rules about how much, or you have to disclose if you have people that are being paid that are trustees or family members. I mean, there's a lot of rules around these. There's a tax return that has to be filed every year. So it's really not recommended that someone would set up a private foundation unless they had a lot of money. A couple of things I read said $500,000 would be the minimum. If you're going to have an independent administrator that's not you or your family members, a couple $1 million. So it's a lot of money. And people used to do these with smaller amounts before donor advised funds became available. And so really now most people use a donor advised fund, but this is definitely part of an estate plan. Some people set these up and fund them at death or with a couple of these other tools that I'm going to recommend. Or discuss. I'm not really recommending that we do them. They're pretty technical, but
Kathy, what does the acronym NAV stand for?
Net asset value. So you can't just put a bunch of money in a private foundation and let it sit there. You have to give away 5% every year. That's the rule, or you pay an excise tax. So there are two what are called split interest trusts that I'm going to talk about. The first one is a charitable lead trust. And a charitable lead trust is a tool where you put in the money. A charity gets money from every year and your heirs get the remainder. So it works really well when there's a low interest rate, because what happens is you do a calculation to figure out what the gift is you're giving to your heirs. That's a taxable gift. You file a gift tax return for that, but you're kind of betting that you're gonna do better than the IRS's mandatory rate for that. This is so technical, I'm sorry, but there might be people that are interested in it, so I want to talk about it for the tape. And so what happens is your charity gets this amount every year, and there's money left over. You didn't spend it all. Mathematically, you're supposed to spend it all, but as time goes on and you invest it well, it does better than the rate that you have to use. The 75-20 rate right now, let's say, is high, but there was a time when it was super, super low, like 1.5%. Well, everybody was doing way better than that in the stock market. And so these were great ways to transfer wealth, support a charity, and get a lot of money out of your estate without using up a lot of your unified credit. So that's all I'll say about these for this discussion. But if anybody online wants to talk about it more, if you listen to this, I'm happy to discuss it in more detail with anyone that wants to. The other one is a charitable remainder trust. So this is a situation where you put money in a charity, in a trust, you get money every year to you, and at the end of that term or upon your death, a charity gets the remainder. The church just like 2 months ago got a check from somebody who was a longtime member of our church that I didn't think was a super, super wealthy person. So people do these when it works right for them and their circumstances, from a charitable remainder trust that someone had set up years ago, and he passed away and we got our share of the remainder. So these work better in high interest rate environments because there's a required amount. When you do the math, the charity has to get at least 10%. And so when the interest rate is higher, it works better. So these are often funded with appreciated assets. So I'll talk about that a little bit. I had a client who set up a charitable remainder trust. She had an incredibly valuable piece of art, and she needed to raise funds. Her husband had become very ill, and his costs of care were getting really high. So we set up a charitable remainder trust. She donated the art to the trust. The trust sold the art. And over time, as she took the distributions, that capital gain came out to her a little bit at a time, which is how trusts work, as opposed to her selling the art, paying a huge amount of tax. So it gave her cash flow, which is what she needed to pay her husband's care expenses, while stretching out that tax bill over time. So it can be, I mean, there's just so many cool techniques out there. So this one often gets paired up where the charitable remainder is your private foundation that you set up. We see that a lot too. So, and so then it sort of stays in your control, and you can do what you want with it. So, so that's all I wanted to talk about today. And these last couple are super, super complicated, but some of the first few are quite easy. And so find me after church on Sunday. Like I said, I'm retired now, but I should still remember this for a few weeks. And I'll be happy to talk specifically with you about one that you might be interested in. So I hope it was helpful.
Are you prepared to do one? No. Just kept.
How do I stop the recording? Let's see here.
Did you say these were gonna be available
Escape.
online?
Yeah.
Yes.
Yeah, this has been recorded, and there'll be a link somewhere, I guess.
Yeah.